Hi, this is Evan Hutchison, and today I want to go over the estimated tax planning for construction companies. So, if you are a construction company or you're the owner of a construction company and you're making less than $10 million per year in revenue, you are probably filing your taxes on the completed contract method. If you make more than 10 million in revenue, there's certain regulations that require you to do percentage of completion, which is not as beneficial from a tax standpoint. Completed cost method allows you not to recognize those properties that were not complete as of year end. With percentage of completion, you have to, as the name implies, you have to recognize a percentage of those properties based on your actual costs incurred to date. So you're usually showing revenue on uncompleted jobs, whereas completed costs, you're not showing any revenues on any jobs that aren't materially done by the end of the year. So this company, XYZ Construction Company, is earning maybe about $7 million a year. So they are good under the completed contract method. Regular companies that aren't in construction, they just do simple cash or simple accrual. Some smaller construction companies do it that way, but it's beneficial to do it using the completed contract method, because, as I said, you don't have to recognize all that income that you received during the year on uncompleted jobs. So here's a little balance sheet of the company. As you notice right here, here's an asset, the overhead allocated to uncompleted jobs. That's for 2016, 12/31/2016. We, of course, created the tax return, and a portion of the overhead that was on the books for the year 2016, we allocate it towards completed jobs during that year, which means we were deducting it on the tax return. Now there's also a portion of that overhead that we allocated towards uncompleted jobs during the year, which would be completed in 2017. Because we're not recognizing the income from those jobs in 2016, we're also going to not recognize the overhead allocated to those particular jobs in 2016. So instead of expensing it, we credit the expense, debit the asset, put the asset on the books. Then once 2017 ends, we'll take that asset off the books and expense it along with those jobs, assuming they're not long-term contracts that last more than a year, in which case that's a whole other issue, because then you get back into the percentage of completion method. But this is a residential company. We're just doing some spec homes and some other contracts, and they're all lasting less than a year, so we don't have to worry about that. So that's the balance sheet. The income statement is right here, if I can pull it up. And what I'm doing with this income statement or profit and loss statement is I'm separating it by job. So we can look at the P&L as a whole, and that'll give you an idea of where the company is. But then I separate it by job, so I can figure out these costs, the job costs. And this is as of 8/31/17. So we're not filing a tax return right now. We're just trying to figure out where this company stands in regards to the future tax return that we will be doing. And from that, we can make different financial decisions, one of which, of course, is an estimated tax payment to try to get some of these taxes in. But basically, I did the full year up to date, and I separated it by job. So we start with overhead. If we scroll down to the bottom, we see that overhead obviously there's no income in overhead. That's just expense. So we see that we've incurred $333,000 in overhead. Now I use a spreadsheet for all of this, and there's different tabs, and this is a pretty messy spreadsheet, by the way. Obviously you'll want to make it look a little nicer than I'm making it look, but I put it together probably a little too quickly. So I took that 333, I put it right here, and since August is 8 out of 12 months, I just divided the number by 66% to come up with the total year amount estimated of 505,000. Now we are currently estimating that 75% of the jobs that we have on the books will be completed by year end. Therefore, this is just rough. I mean, we usually base it off the cost of goods sold of the jobs, but since we're just doing this quickly to kind of get a quick answer in the books, we instead are just throwing it together and saying, hey, look, of that 505,000, 75% is going to be allocated this year. 25 will be allocated to the following year. So we're taking out 25% right here. So 505 minus 126 plus this 65, remember from the balance sheet that we did not incur in 2016, that's going to be the total overhead cost of 444,000. So we go to this last tab, P&L for estimating taxes. We put 444 right here. Okay. Then what we do is we go through the jobs. So we start with Skyview. We're showing 874. The first thing you probably want to do is you'll of course know when doing this, or the CPA or the accountant or whoever will know what jobs are complete, what jobs aren't for the most part. So you can find it a little bit quicker than probably what I'm doing right now. But I would go to, there's three different tabs where you're actually four different tabs. This one right here, completed jobs, residual jobs, construction in progress, and contracts. So each job that we see in QuickBooks falls under one of those tabs. Skyview, we finished that job long ago. These are just expenses that have been incurred. We haven't closed out the job on the books. It got completed back in mid-2016. This is maybe some warranty costs, maybe just random costs that are being incurred during 2017. So you could just put that under this tab right here, 874.18. So we have 874.18 of income. You see it's a positive. So that's income. And then there's other jobs, 11, 12, 15, 42, 64. If we kind of go down the line, I mean, usually you'll just go one by one. But for the sake of this video, I kind of want to show you all the residuals, then all the construction in progress and so forth, just so we don't keep bouncing back and forth. But if you go to some of these other residual jobs, Canal Street, negative 43. Canal Street, negative 43. We have, let's see, 101's Church Street, 103's Blair. 101 Church Street, negative 1672. 103, negative 17.79. So you see we're putting that here, we're putting that here. We're just putting these excess expenses from old jobs on this sheet. Because when we file the taxes, I mean, none of this is going to be allocated to overhead or anything like that. We're simply just putting this in the books as a income/expense. In this case, it's a loss of 4,432. So it's pretty simple in regards to these older jobs. We just throw them in the system. Now there are some rules when you get bigger, and maybe you're doing percentage of completion, and you've put in 90% of your income, 90% of your cost, and the next year, for whatever reason, you don't incur that remaining 10%. Maybe you do the following year. you're required to go ahead and put that 10% in the books on the taxes. I mean, there's certain regulations or rules involved. We're not getting into all that, but I'm just saying that this is kind of just a quick way of doing a smaller construction company. We're just throwing these in here to adjust the tax return, but we're not really doing much else with them. Now, when it comes to, say, a contract, let's go to 114,987 Park. Now, whoops. Now this is, as you see, this current year, 1/1/17 to 8/31/17. So if we go to that particular job on here, it's just going to show the current year. So what you want to do is you do a full P&L for all these jobs for the time of the year, you know, the first 8 months or wherever you are. And you pick and choose the ones you need to pick and choose. That overhead, for example, these residual jobs. But then when you see a job that is completed, or that's about to be completed, for instance, it might have started the previous year, in which case you want to create another profit and loss statement to do that part of the spreadsheet. So let's take a look at maybe this P&L, if it'll come up. All right, let's go back to the spreadsheet. So this is 114 Park and 117 Percy Warner. The contract amount is the total amount you think you're going to earn on the contract. The estimated total cost is the total amount you think you're going to incur. So in theory, your income is going to be 876 minus 772. The costs to date are just as you say, the cost to date. So if you go to QuickBooks, we're looking at 114 Park. Cost to date is 435 plus 1900. 435 plus 1900. So the cost to date are 437,000. So the percentage complete is 57%. 400, because the percentage complete is based on the cost, not the revenue, because you can receive however much revenue. You could overbill or underbill. We'll get into that in a second, but 437,000 is 57% of the estimated total cost. Of course, this could be subject to change with change orders, things like that. So you got to always keep in mind that there's always parts of the spreadsheet that could be changed and could alter everything moving forward. But we're just going to say there's no change orders. That's the total estimated cost still. The billings to date is how much you've earned or not how much you've earned, but how much you've actually received. So we've received 530,000. So that's what we're putting right here. The contract earned. Now this is a percentage of completion spreadsheet, but we're still using it just to kind of basically see where we are in the project, see if everything's correct, and that way we know if we're on track. So we see that the contract earned is 495,000. That is based upon the percentage of completion. So 57% has been complete. We multiply 57% by the contract amount, we get 495. We received 530, so we've billed out 34,000 more than we have actually earned from an accrual standpoint, from a percentage of completion standpoint. Now that's a good thing, you know. We want to keep on. That means our cash flow is probably good. It's definitely good with this project. We're billing out way more than we're receiving at this point. And if you keep the overbillings rather than the underbillings, you're on the right track from a cash flow perspective. So you need to try to stay on the positive side there. But you kind of use this information to make sure that your project looks how you think it looks. If there's something off, then you need to drill down You can of course go to the actual versus estimate detail in QuickBooks, drill down on those expenses, see what's going on, look at the invoices, the open invoices, make sure there's nothing past due. Just, you can always mess around with different reports and learn a lot from them. But all we're really doing right now is like saying, hey, look, we still think this is accurate. All this looks good. So we are taking this total amount and this estimated amount, and we're looking at the net profit of 103. Okay, and we think that's going to be completed by the end of the year. I know it only says 57% complete, but we're gonna work hard on it for the last 3 months and get it done. So this 103, along with these two, it's the same scenario. Move over to this P&L for estimated taxes. 103, 98, 96. They're all right here. So we're assuming we're making that much money. If you go to these projects, 06 Commerce Street, same sort of thing. This is construction in progress. So this is a spec home, actually. So he owns the property and he's selling it after it gets built. He's incurred 748 plus 67. So what's that? That's 815 or so in expenses, which is this number right here. Land costs of 510. Now, one thing to keep the books accurate, these are actually inventory items. This is an inventory item. So is this. It's a construction in progress. It goes on the balance sheet. We have a balance sheet right here, and you'll see that that's it right there, 510,000. But that's only the land, because I just wanted to show that show it on the P&L as well. So this should really get moved over to the balance sheet, because we own this property. We're putting it on the balance sheet because it's inventory. It's not an expense. It's an asset to us because we're building on a property that we own. But I just wanted to kind of show you, along with the other expenses, how it looks. I mean, we're putting all these in the specific item codes. One thing you can do to make it work is these item codes get mapped. So you can create 2 different item codes for each one. 50,017.2 closet organization contracts, 50,017.2 closet organization spec homes. With spec homes, you map them to the cost of goods sold account. With regular contracts, you map them to the direct cost on the P&L, direct materials, direct labor, that sort of thing. But that's not what we're going over right now. I just wanted to say there is a way to do it differently. This, like I said, this set of books is just a little messy. I'm just working with what I have right now. But we see that we have this, whatever, the 812 grand of construction in progress, 510 grand of land cost. That's our projected sell. We don't know. It's not like we're earning a fee on this. We're just selling it for what we can sell it for. This is our projected cost, so we've almost built the whole thing. Since we own the property, we got to pay closing costs, 6% of commissions. There's going to be a few more, but that's the main thing. So then we take, and we believe we're going to sell this by the end of the year, so we take this 1.75 million minus this, minus this, minus the closing costs equals 230 grand. We also think we'll sell this, so we put both of those on here as well. Then maybe he's married to someone who works, a smaller job, and we're just taking half of the income since we're close to half of the year. If we wanted to get more accurate, of course, we can take 66%, put it right there, and that's kind of it. We have I forgot to do the completed jobs. Okay, so the completed jobs, I believe, right here. So 125, 126, and 60. These were completed during the year. They're not almost complete. They've already been completed. So we just take the income from each of these, 221, 28, and 150, and put them right here for a total of 408. So we take that tab, put it right here with the residuals, the overhead, the wife's income. And there, you know, of course there could be some other stuff on the tax return. There might be he might have a SEP IRA that he puts 50 grand into each year, that sort of thing. But for the most part, we're showing this amount of income, 790. Maybe he's already put in 125 grand towards taxes, so he needs to put in another 125 or so in towards taxes. And this way, this spreadsheet, it's not just for estimating taxes. That's a great benefit of it. You know, you can do that and figure out how much you're going to owe towards the end of the year. But it's also to make sure each job is showing a decent profit, and that's kind of where the percentage of completion is. We just need to make sure everything's on track. But if you do this at least once a quarter, maybe even once a month, you'll have it'll give you some peace of mind, and you won't be caught off guard at any point by any jobs that suddenly are not making money. And you can, for longer term contracts, you can do fade analysis and gain analysis to make sure each month is on tune or for what you think is going on. You're not showing a gain here, then a huge loss there, and then a gain there. It's kind of staying consistent and that sort of thing. So this is just a spreadsheet I use for a couple of messy companies. Obviously, if there are some sets of books, some construction companies I have that I kind of set up my own, so they're going to be a bit cleaner, and I do it. I still do it similar to this, but it just looks a little nicer, of course. But this still works, and I use it a lot. I use it every quarter with this company right here. So, anyways, I hope this helps a little bit, and talk to you soon. Thanks.